Hello and welcome to CNBCTV18. I'm Shireen Bhana. 2017 has been a mixed year for M&A in India. On one hand, we saw private equity deals surging to their highest ever, but on the other, we witnessed a 30% slowdown in M&A activity across the board. Industry has stayed cautious, waiting for clarity on key economic reforms, the goods and services tax, the bankruptcy code, to name just a few. A slowing economy didn't help Deal Street much either. But will 2018 be better as the country moves into election mode? There is a promise of more economic reform, further easing of regulatory hurdles, plus the government has lined up a massive disinvestment plan of over 70,000 crore rupees, which could add more sheen to the glistening capital market. Welcome to Eye on India, and today we take stock of the M&A year that's gone by and discuss what investors at India Inc. will look forward to in 2018. Joining me on the show today, Anil Rai Gupta, the CEO of Havells, Dhanpal Javeri, Managing Partner at Everstone Group, and Ajay Arora, the Head of M&A Practice at EY. Gentlemen, appreciate you joining us. Dhanpal, let me start by asking you, because while we've seen an overall 30% slowdown as far as broad M&A is concerned, it's been a great year for private equity. Do you believe that 2018, the enthusiasm that we've seen within the private equity space is likely to continue? And what about valuations? Is that a cause for concern at all?
Thanks, Shireen. Thanks for having me on board. And I think, to answer your question, 2018 continues to be, in my view, a year where you will see significant private equity activity. I think if you look at the macro factors, we, as an economy, are showing benign interest rate environment. We are seeing a stable currency, and we are seeing strong fiscal factors which are ensuring that the government balance sheet is reasonably intact. I think in spite of the short-term, structural reforms around GST, I think the long-term outlook for reforms such as this augur well for the Indian economy. So as PE investors, we tend to look at a slightly more secular long-term trends, and India currently clearly continues to have strong platform and base on which to invest capital and generate returns.
Okay, I'll talk to you about the specifics in just a bit, but let's talk about the India theme that you brought up there, Dhanpal. And let me ask you about that, because you've decided to bet on the consumer durable market, and you decided to do that by way of an acquisition. You acquired Lloyd's earlier this year. You decided to exit Sylvania as well, because you're betting more on the domestic consumption story. Am I right?
Yeah, exactly. I think as Dhanpal just mentioned, the macroeconomic situation in India looks very good, and not just in the short term, but we estimate that at least for the next decade or two, India offers a great opportunity for proper capital allocation and getting the right returns on it. And I think as a company, we looked at the various possibilities all across the world, and we found that we have the best interests in India, we have the best capabilities to manage businesses in India. And if we are in the sweet spot for the next decade or two, then why we should not be investing more capital in India rather than within the globe. So that was our reason that we exited Sylvania and utilized the entire cash proceeds from that and invested more in India. And in the consumer durable space, we believe that the time is there for the consumer space to get better and better. And branded play, the channel play is definitely going to get a lot of fillip in the future.
So one of the themes, and I'll take that forward and discuss that with Ajay and Dhanpal as well, is this shift from unorganized to organized, which on the back of the GST is going to be a theme that we're seeing play out across a lot of sectors. The consumer durable space is a highly competitive, perhaps even somewhat commoditized business. How do you see this playing out for a sector like yours?
Well, I would rather say that, if you look at the last 10 or 15 years, this whole shift from unorganized sector to the organized sector is already panning out. Because the consumer is getting more and more aware of the quality of the products, the cost of their housing is increasing, and hence they want to put in better quality products. What has happened in the last 1 year with 3 changes, the demonetization, the RERA, as well as GST. All these 3 changes augur very well for organized play. And already we are seeing on ground some shift happening from the unorganized to the organized sector. And that's where I think the next few years will be a great platform for the organized players as against the unorganized player. And the consumer will continue to focus more on getting better quality products from better manufacturers. So I think this whole move in the last 3 years of last few years is already panning out and has been accentuated in last year.
Accentuated and gathering more momentum. But Ajay, if we listen to what Dhanpal said and what we just heard here from Anil, we've already seen a significant dip when it comes to cross-border M&A on the back of the fact that domestic investors are betting on the domestic story. Do you see a return of any appetite at all for India Inc. to look outside?
So on the cross-border side, you're right, Shireen. We have had significant slowdown over the last couple of years. Outbound has been largely impacted, primarily because most of the Indian corporates have been cautious buyers overseas. Apart from a few sectors like technology and pharmaceuticals, where either to have a footprint in that market or to get customers, I think the companies are acquiring overseas. But I think broadly, if you look at it, most of the domestic corporates are focusing on the Indian market. And with assets available at the right price in the Indian market, that's where the incremental dollar is going from the Indian corporates. So from an outlook standpoint, outbound expected to remain cautious and a bit soft. However, I think inbound, driven again by the domestic consumption story, the growth in the Indian market, we would expect outbound, inbound, which was a bit soft this year, to rebound next year, and you would probably continue to see. You'll probably continue to see inbound activity going forward.
Okay, domestic deals, as you just pointed out, and that seems to be the consensus of the panel, we've seen that steadily move up in the last 5 years from about 6 billion to about 28 billion. But Dhanpal, coming back to you now, and 2017 has also seen, from a private equity point of view, one of the best in terms of exits. Given what we are seeing with the robust IPO pipeline that's already lined up, what could be the triggers and what could be the trends for 2018? Is control going to be one of the big plays that we see when it comes to private equity investments? Will private equity play consolidator much more in 2018 as well?
So, Shreen, you make a great point on this, and I think, partly this is driven by, I would say, supply side issues. Over the last 10 years, there's a marked change in the way corporates and entrepreneurs are looking at ownership in their businesses. I think there are two clear trends we're seeing on the supply side. One is that entrepreneurs are today, there's no social issues around selling businesses. In fact, in many first generation entrepreneurs, they almost see it as an opportunity to create significant value in kind of harvesting and selling their businesses. As far as corporates are concerned, I think corporates are beginning to think more about balance sheet issues, streamlining their the bloated kind of, balance sheets, selling non-core assets which are really not added value additive from a long-term basis, and trying to also take cash off the table. And I think that has led to significant amount of interest from the private equity community, which is now seeing meaningful deal flow to actually go and buy businesses, own businesses. The second factor, I think, is talent. India has now thrown up a huge pool of professional talent who've scaled businesses and built world-class businesses over a 10-20 year period. That talent, fresh of the success of having done work in larger corporations, is hungry to actually create and replicate success in businesses which are private equity owned. As you know, the private equity ownership, we tend to look at in 5-year kind of chunks of time, and that means that we need to grow businesses, we need to build them, and it's all about execution. So getting high quality talent, putting capital to work, buying businesses and building these platforms really is where we think there will be a lot more activity.
Okay. Anil, if I could ask you about one of the issues that perhaps we haven't discussed on the program just yet, and that could be a significant factor. You haven't had the problem of having to sell non-core assets to sort of prop up the balance sheet because you haven't had a problem with debt. But that's a problem that's staring corporate India today. The twin balance sheet issue is a real issue, and it hasn't been quite meaningfully addressed. You also have the issue of the IBC, and that process is gaining momentum. So this distressed asset sale, I'm not sure if it interests you in any form or fashion at all, because it's not traditionally the sectors that you may look at. But could that be an opportunity for somebody like you as well?
Well, it's not necessarily for us, but it will be a huge opportunity for strategic investments and financial investments coming in. In the first decade of this 2000s, a lot of companies got into non-core businesses because of free availability of capital, both from the debt markets as well as from the equity markets. And I think Havells stayed away during that time from those temptations, but a lot of companies did that. And I think, as Dhanpal just mentioned, over the last few years, people have started looking at selling those non-core assets, which are good assets, but except they are lying in maybe the wrong hands and the wrong balance sheets, and they need to be again, reallocation of capital has to be there, and there can be great assets for any strategic buyer or a financial buyer. And I think we'll all obviously be interested, but again, we've been a financially disciplined organization in the last few decades, and we would continue to remain so. We'll buy assets only which make strategic sense for us, not purely financial sense, but strategic sense.
Ajay, let me put that question to you. Is that going to be a big theme that will play out in 2018? We've seen the start of the IBC process, whether it's steel, whether it's telecom. I mean, sector after sector, there are opportunities, and consolidation is inevitable. Is that going to be the big theme of 2018?
In fact, that will be the biggest theme next year, because you would probably find the companies that are currently under the process and the additional companies which are lined up, you'll probably have incremental deals that will happen which could even go up to $15 to $20 billion. So this is real big ticket M&A. This will probably attract interest from the larger Indian corporates who are looking at some of these steel assets, some of the distress focused funds globally who are trying to look at some of these assets, and some of the global players in these sectors. So on a pure play basis, you'd probably look at close to $20 billion of incremental M&A happening just on the back of IBC driven sales that are going to be closed next year. And the more important part is that the sale process under IBC is a very, very time bound, structure driven process. So overall, it's going to really act as a boost for the transaction market in the coming year.
Dhanpal, is this going to be something that you're going to be looking at as well?
We think the whole stressed asset, and more importantly the distressed asset situation, yet is to play itself out to a level where I think serious private equity interest will step in. There's clearly some partnerships being formed between corporate houses and financial buyers who are looking to see if they can make sense of some of these opportunities. But I yet think that it is some time away. Generally, private equity is a cautious, type of capital. They tend to not be leaders but followers. Once the rule, I would say the landscape and ecosystem is well settled, is when we'll start seeing more activity from private equity investors.
So you'll wait for the entrepreneurs like Anil to actually take the first steps along this path,
a lot of the assets right now are more cyclical assets. They're not secular opportunities. So steel, cement, power. These are assets which generally, require a different mindset and different type of capital.
No, you're absolutely right. And that is the perfect note to take our first break. When we return, we continue our conversation of the year that's been for M&A in India and what 2018 holds. Welcome back. You're watching Eye on India. I'm Shireen Bhan, and we're discussing the year that was for M&A in India and what 2018 holds. Ajay, we were talking about one of the big themes that you believe is going to play out, which is the stressed assets theme. But the other big ticket item, and we don't know whether the government will develop cold feet or not as it gets closer to the election, is this business of strategic disinvestment. I mean, we're talking about Air India being on the block. The Civil Aviation Minister says it could take another 6 to 8 months before they arrive at any kind of closure. But do you believe that that could be one of the other big triggers for the market?
Yes, I think the intent of the government on the disinvestment process seems to be very, very clear. And that could again, drive domestic M&A to a large extent, and you could see a lot of Indian corporates and global players looking at some of these assets. So I think clearly disinvestment process would be another important factor that will contribute to the M&A activity in an incremental fashion next year.
Okay, and would that be of any interest at all to you, Dhanpal?
We don't think that's a sweet spot for us. There's a lot more to do in India rather than go and bid for government assets. I think, it's the devil is in the detail, right? How these assets are structured for a sale, because a lot of the challenges in these businesses require literally not just band-aiding but surgeries? And would government be comfortable with a process where someone can come in and conduct surgeries rather than just apply band-aid? So I think the issue is really that there is, like Ajay mentioned, there could be specific strategic interest. I think the government should be extremely open and constructive the way it handled the first disinvestment process sometime in the early 2000-2002 period, where you saw a significant amount of strategic interest come in.
Yes, in the first NDA regime. Yeah.
Absolutely. So I think if they're willing to make some bold moves and take decisions on that basis, I think there could be definite strategic interest in this disinvestment process.
Well, we are yet to see that play out. We haven't seen a single strategic disinvestment take place since this government first spoke about it, and this has been an area of disappointment. But Anil, let me ask you, because you've started the process of integration with Lloyds. For someone who is looking at a potential acquisition, what are the challenges that they must keep in mind when it comes to integration? Because that could, in a sense, play spoiler.
I think one of the biggest things, obviously, a lot of things can be looked at while doing the acquisition, the due diligence process, the financials, the legals. I think one of the key things that we've taken as a learning in our large acquisition of Sylvania and now Lloyd, is how culturally integrated is the team, and how do you bring them into the culture of the organization. I'm a firm believer in this fact that an organization cannot have two cultures.
Yeah.
Right. So when we acquired Sylvania, we looked at various markets. We were present in 50 markets, and everybody talked about a country culture, and we talked about a company culture. We said within Havells Sylvania there should be one culture.
Yeah.
And that integration helped us see the global financial crisis times, and we came out of it very quickly. We retained the company to be profitable, and the same thing we are doing in Lloyd as well. So the entire team which comes in, the distribution team which comes in, the channel which comes in, how culturally they get integrated into the organization, I think that's where the entire senior management focuses on. The rest of the staff, the IT integration, the financial integration, the HR integration continues to happen, and that's a process. However, I think for us, the key learning is that we need to culturally integrate the organization. And we believe that we've been very successful, first in identifying that Lloyd was the right target, that it could be culturally integrated, and now we are in the process of doing that.
Okay, cultural assimilation and cultural integration is one very crucial aspect of ensuring that M&A works. But Dhanpal, in terms of financial structuring, what is it that you've seen in 2017, and what do you expect? And also the question on valuations and where they're headed.
So if you look at on the acquisition front, I think one of the key elements around making the acquisition work for you is really making sure as to how you plan a transition and how do you plan implementation of that transition. We are very, very focused when we do diligence and when we look at buying assets on making sure the management team, which is either coming along with the acquisition or which is being infused into that asset, is completely aligned with what we as a shareholder want to do with the business. And that alignment has to happen even before the deal is complete. And that alignment happens not just at a strategic level, but there is a very detailed 100-day, 300-day and 1,000-day roadmap which is chalked out, which is signed up, and literally is something that both the management and the owner that we work together to execute and deliver on. Coming to valuations, I think, clearly we've seen a significant, I would say, expansion of multiples across pretty much all types of sectors and asset classes. I think the issue with that is that it makes it that much more difficult to justify the returns that we can make, and it requires a lot of growth, I would say, and a lot of operational efficiencies to be built into the businesses that we buy. So you obviously are going to see, I think, some trade-off in terms of returns. Against what you would typically want is a high quality assets that you would want to pursue and own. So, but I do think that quality will definitely trump valuations, and I think that would be the basis on which most deals would happen.
Okay, quality will trump valuation. Ajay, as far as 2018 is concerned, which are the sectors that you believe we're going to see maximum amount of interest and activity? And what's your take on whether quality will trump valuation?
From a sector standpoint, financial services was big this year. I think that will continue to be a big part of the deal activity next year. You would probably see technology again and e-commerce being very, very active. E-commerce more consolidation, technology more outbound and to some extent inbound. On the consumer side, we're going to see continued deal activity, I think largely inbound and domestic, and private equity is obviously pursuing that sector quite aggressively. These could probably be the 3 or 4 key sectors. In addition to that, on the infrastructure side, clearly renewables is seeing heightened levels of activity, and both consolidation and private equity raise will be big in the coming year. You can say the same about roads, which will probably see a lot of consolidation, and real estate will probably attract a lot of capital, and not to mention themes like InvITs and REITs playing out. You've had success this year with a couple of offerings.
Finally,
and probably that'll be important. Finally.
Yes, we've spent many months talking about the possibility of that. So maybe 2018 will finally see that take off. Right. But Anil, I want to end by asking you. We've been talking about the M&A story, but let's talk about the demand story. And does 2018 look any better from a demand point of view? We've had the double whammy of demonetization and GST in 2017. We're still grappling with the pain of both those issues. From a demand perspective, do you believe 2018 is going to bring better news?
Absolutely. I think I'm very confident and hopeful of 2018 being much better because, the short-term pains that we had because of demonetization and GST are actually structural changes. Whenever you make a structural change within the company also, it will have short-term pain. But obviously, you're doing it for the betterment of the economy or betterment of the company. Similarly, I believe that both these actions definitely are going to help the consumer story, the demand story in the country, and hence I'm very hopeful that 2018 will be a much better year.
Will be a much better year. Dhanpal, I'll give you the final take. We've seen total PE exits in 2017 through IPOs, about 18, which accounts for almost $2 billion, which is the highest ever. Do you think exits will continue to be a big theme in 2018?
I think there is a very clear demand from, I would say investors, and this is partly driven by a shift from physical to financial assets for quality offerings. And I think therefore from a demand perspective, we do believe the capital markets will continue to offer significant opportunity to generate liquidity and exits for the private equity industry. From a supply side perspective, I think everyone will be keen to try and, there's nothing on the horizon really. There are no clouds on the horizon right now. The only real event which is going to be there is the 2019 elections. So my view is that anyone looking to raise capital, anyone looking to generate liquidity will use 18 as a year to try and do that.
Okay, no clouds on the horizon just yet. Bite your tongue, gentlemen. We've seen things turn and turn very, very quickly. But it's been a great year, at least as far as the private equity M&A space is concerned in India. Overall, it's been subdued on the M&A front for the year that's gone by. But 2018 should bring better news, and the domestic story will be the one to watch. Anil, Dhanpal and Ajay, appreciate your time. Thanks very much for joining us here on Eye on India. With that, it is time for us to wrap up this CNBC TV 18 special from all of us here. Goodbye. Many thanks for watching.
Presented by